It's tax season, and if tax season keeps surprising you, it really is time to change that. 5Q IQ Financial Power-Ups with Trajan Wealth breaks down the taxes that hit the hardest, how to fight back, and it all starts now. Welcome to 5Q IQ Financial Power-Ups from Trajan Wealth. I'm your host, Jeff Jr., with fiduciary advisors Marty Bryant and Corbett Leduc. Also joining us is a Trajan tax CPA, Jaden Allen. Welcome, Jaden.
Thanks, Jeff. Happy to be here.
So today we're talking about taxes that don't blindside you. Questions about getting advice from a real tax professional. Should you consider Roth conversions? Will your kids owe taxes on what you leave behind? What can you do now to avoid future tax pain, and why self-employed taxes feel so darn brutal? I know I can relate to that one. If any of that hits home, send your questions to trajanwealth.com/5QIQ. So let's dig in. A lot of folks only speak to a tax professional once a year, but there really is a big difference between a tax preparer and the kind that you see on TV and in your phone, and a tax pro who can not only prepare your return, but also craft a genuinely good tax strategy. So let's tackle this question. Why does anyone need to see a real tax professional each year? That's a good one. That's big. So why do they even need to see somebody like you?
Yeah, one of the reasons you'd want to see someone like me is because the more information you give to an actual human, like a CPA, and they can be able to understand your situation, they can be able to craft a tax strategy to your personal needs. And that's very, very helpful. Whereas when you put it into a software and do it yourself or figure things out, you're not sure if that's really fitting what you're really needing in terms of tax strategy.
So the software that they're using, they can't personalize it. It doesn't know how to ask certain questions.
Right. Yeah. Most tax softwares and even professionals, they focus on the past. And really what a good CPA will do is they look at the future. And tax strategy is really forward looking, just like a car. You're looking through the windshield. Rearview mirror does matter. We do need to take care of the past, but we really need to be planning for the future. Yeah.
Well, and especially when, we keep talking about our family office that we have. And when Corbett and I are meeting with people, we have clients that have ISOs, RSUs, and it's extremely important to understand how those can affect your taxes. And when we sit down and we get to work with Jaden and his team, they can really craft what makes sense as to when to exercise.
Do the deep dive.
Yeah, do the deep dive in there so that we're not inadvertently creating a larger tax burden than we really should.
Right.
Right.
A huge difference on the ISO's part for stock options, but certainly, you hit it right on the head, Jaden, is the ability to look at forward taxes, and Roth conversions and all those things that can come into play to help minimize taxes in the future, especially when it comes to RMDs.
Absolutely. Yeah.
So is there any level of complexity where a CPA is needed, or would you say everybody needs a CPA, or after a certain amount of income or deductions or family situation?
Right. Yeah. No, I talk to people from all walks of life, and I would say once you are making a good amount of money, or you feel like you're being inefficient, I'd say it's a great time to check in with a CPA, make sure you aren't missing something, because we had someone just do that recently, and they were missing $10,000 a year.
Does it generally cost people anything just to get a second opinion and give you a copy of their tax return and say, hey, look at this, what can you do?
Right. No, yeah. No, that's free. We're happy to kind of get that in during tax season, especially if you're wanting to engage us as a tax, to do your taxes. But if you're wanting just a second opinion and you keep doing it, then there's probably a little fee for that. But it's well worth it to know you're not missing something.
Our next listener has heard this phrase tossed around many times, and the question is, should I be doing a Roth conversion? So that's a great question. We hear it probably hundreds of times a month here.
Oh, yeah.
So let's discuss, should I be doing Roth conversions? Who wants to start with that one?
So Roth conversions are going to be determined by the need for the money from from our side. And again, I'm going to harp on this. This is why we have to work with your CPA. We have to have these conversations, because we look at it from, hey, how soon do you need the money? And, is it going to make sense?
Where are you at on the tax brackets?
Right. And you have to use your cash to pay the taxes.
You should.
But Jaden's going to look at it from a different standpoint.
Right. Yeah. There's two big considerations, right? One is individual tax. The other one is estate planning when you pass on. So if you have a traditional IRA and you pass away and you're moving all the assets to the next generation or the other beneficiaries, a traditional IRA is taxable. And a lot of people don't realize that when you're in retirement, you're most likely in a lower tax bracket than the next generation. Right. Hopefully, if everything's going the way it's supposed to.
Right.
And so you need to look at that. And so you need to analyze, is my tax bracket higher or lower than the next generation? If it's lower, you do need to realize that if you died today, taxes are going to be diminishing your estate for your kids and anyone else that you're trying to give it to. When it comes to individual tax, you nailed it. How long do we need to, when do you need the money and everything else like that? But what we try to make sure is when you were working, were you in a higher tax bracket than you are now, which ideally is hopefully the case. And then if you are, how much tax do you want to pay now compared, taxes today, but then that growth can be tax free. What's your horizon? What makes sense for you? But ideally, again, it's those tax brackets. Because if you were working and you're in the 22% tax bracket your whole career, and then you retire and you're in the 12% tax bracket, you're basically just saved 10% on your taxes in just straight up numbers.
By delaying it.
Well,
delaying it, yep.
As long as when you do the conversion, you keep it in that tax bracket.
And that's what we have to look at. And that's, again, why we have to, coordinate. Because if a financial advisor just says, hey, let's just do a $30,000 Roth conversion, but then you jump a tax bracket, that might not have made sense.
But I'd also say age doesn't necessarily have everything to do with whether you should do a Roth conversion or not. Because just because you might be old,
like Marty,
like me,
you might want tax-free dollars going to your kids. Essentially, you're paying your kids' tax on their behalf.
Yeah.
So that's not. So don't look at age as though that's the requirement.
Exactly.
And I think you brought up another point too with a financial advisor. Oftentimes when you work with a financial advisor, they say, yes, let's do a Roth conversion. They don't consider all of the tax ramifications that could potentially have in the back end. And I think that's why our family office side is such a valuable aspect.
All those different things that, if you are an unseasoned amateur fiduciary advisor
or broker.
Or broker, even more so.
Even more
let's do this. It sounds great in theory. And then the next year they're like, oh, hey.
Right.
Well, it's whatever the latest and greatest on YouTube is at this point.
Right,
I mean, if somebody sees something on YouTube and then suddenly it comes into our office, we have to walk them off the ledge and wait a minute, this is a calculation. It's
hopefully
not,
they were on YouTube and they saw 5Q IQ.
Hopefully.
To get proper information.
Yeah, I'm such a big advocate of Roths, though. I mean, Roth literally is the only thing out there that's tax-free. I mean, you could say life insurance, but that has a lot of cockamamie costs associated.
Right. Cockamamie.
Cockamamie.
Yeah.
You haven't heard of cockamamie?
that's a technical financial.
That's a Wisconsin word.
That might be a Midwest. That might be a Midwest thing. But great discussion. Roth conversion is incredibly important. We help clients with that every day. So if that's one of the things that's on your radar and you're not sure where to start, come and tell us a little bit more about your situation at trajanwealth.com/5QIQ or simply reach out to us. We'd love to help. So our next listener asks this question: will my kids pay taxes on what they inherit? And we kind of discussed this with the Roth conversion, but will kids pay taxes on what they inherit?
Yeah, no, that's a great question. And just to your point, we already kind of addressed it, especially with IRAs or qualified accounts. If that's coming down to your next generation, it is taxable. And there's also generally a timeline that you have to take it out. Otherwise, you get penalties, which is a tip for the government. We don't like leaving a tip for the
10
government.
years.
Yep, 10 years.
10 years, they have to liquidate that whole account.
Right. And then other types of, you have some other investments, kind of like annuities. There's some, nuances there. You kind of, again, that's why I lean on the financial advisors there. You guys understand those so well. And so if you ever have those in your portfolio, talk to your financial advisor and understand the ramifications there. The other thing that we need to address is, let's say you have a house. This is one of the biggest errors that I've seen is, someone's has two homes, they have a retirement house, and then they become elderly to where they can't go there anymore. And they go to sell it. Well, if you sell it, you actually have to pay tax on that. You have capital gains. But if you keep it in your family name, keep it in your name or in your trust, and then you pass on, your next generation gets that at an adjusted basis. So they don't have to pay tax on that other house. So things like that, any other assets outside of those are important to analyze. And generally the answer is you get an adjusted basis so you don't have to pay tax on it.
Now, do you get the step-up basis on both houses or just on the second home?
Right, you get both houses.
Okay.
So it's pretty much all assets, but there is an estate tax, but
It's so big that
it's almost $14 million now. So if you're over that, you should already have a CPA
Right.
well into that plan. If you don't,
better.
you need to contact us now.
If they don't, call us now.
Yeah.
Ask for Corbett.
Yeah.
And he'll refer you to me.
Yeah.
So I
yeah.
just want to touch on one thing real quick, if I could.
Yeah.
Will you please clarify? And so I want people to hear it from a CPA's mouth.
Right.
What I'm seeing more and more frequently, one parent's passed away. It's just mom left, and she's going to put her daughter on her bank account. I put my daughter on my house.
Yep.
You know,
This happens
and
a
that's
lot.
a huge mistake. And I'd
It
like you
is.
to talk about that, please.
Right. Yeah. So what happens is when you pass away, it's your assets. And if it's a shared asset, then it has to be a proration of how much was the percentage. So if it was 50-50, you really only get a 50% adjusted basis. And so it is very important. You can sign over, talk to a lawyer, sign over your power of attorney. Find a way to include the daughter, include a trusted individual, but don't sign over title or anything like that to anyone before you pass away without knowing that that's kind of affecting your estate tax, your tax benefit on dying. Yeah.
And you file a lot of taxes, individual, businesses, corporation, trusts.
Estate and trust.
So as far as estate and trust, we don't need to get into the trust specifically, but are there additional tax benefits that people who have a trust can garner?
Yeah, that's a great question. So a lot of it has to deal with the estate tax. So when people are that wealthy, getting an irrevocable trust does that. When you just have a pass-through trust, there's not many tax benefits unless if you want to file a separate return. That's an option that we can talk to, people can choose with their CPA. The main benefit is when you pass away, in the state of Arizona at least, when you pass away, like let's say the husband passes away, the wife gets an adjusted basis. And whereas in a community state like Arizona, that's not always, it gets a little more complex, but a trust simplifies that. So
When you say filing a separate trust tax return, why would you do that?
Right. Well, I mean, there's a lot of reasons. One of them is some legal protection, from my understanding. So if someone comes after, let's say the trust owns a business interest, and the business is getting sued or some litigation there, it's just another barrier saying, hey, it's actually not fully owned. Like it is owned by me, but it's just another barrier for them to get back to you
by filing that trust tax return.
Correct.
But trust tax rates are going to be higher than personal.
Right. Well, actually, so yes, if we keep the money in the trust, but the way we can do it is we can distribute it out to where actually the individual still pays the tax at a better rate. Yeah. Just for everyone listening, if an individual is a car going through the tax rates, a trust is a rocket ship. So keeping money in a trust is very disadvantageous, but sometimes there's a reason to do that, right? But there's no tax reason, but there might be a life reason.
Yeah. Great question. And you can see it gets rather complicated.
It gets complicated
rather
fast.
Complicated rather quickly.
Yes.
And if you have questions about your plan, don't hesitate reaching out. We've got
Please
Jaden
do.
and the tax team standing by. This next question flips the script from looking back to really looking ahead. So the question is, what should I be doing now to avoid future tax? The $1 million question, right?
Absolutely.
How do you feel about the word avoid tax?
Yeah, tax avoidance is absolutely legal. Tax evasion is where we get in trouble. Yeah.
There we go.
Yep. Yeah, no. So, I mean, a lot of people look at their income and they're like, man, I'm paying so much in taxes. Like, it's really sometimes kills people. And again, that's where you have to
Remind them that they're making money.
Yeah, you remind them you're making money, but also what ways are you making money? Yeah, and because the laws change so much, there's a lot of misunderstandings about what is actually deductible and what's not, right? What makes sense? And so, for example, anyone that's in an Airbnb right now that owns one, you need to see if your rental days is under 7 days or not, because those are treated differently than rentals that are longer than 7 days. And so even things like that, and that was a new Treasury regulation within the last couple of years. And so I know CPAs that haven't, kept up with that. And, I've looked at those returns, and we had one client that missed out on almost $35,000 of deductions.
Wow.
Holy
Yeah.
cow.
And so it's a lot of money. Yeah. And so, you go back and amend, and it's worth it.
Right.
So when you're paying too much, you need to ask, am I really getting the best service? Because if you don't have an active CPA, someone that's actually looking forward, having a conversation post April 15th, you could be missing a lot.
So can you open an LLC for somebody and to help mitigate?
Yeah, I myself don't do LLC formation, but when you
But the
create
good
an
news is
LLC,
that we know somebody who does.
We do.
we have
Yeah.
an estate
Estate
team.
teams.
Yep,
Yeah.
exactly. So we work closely with them, and when they create an LLC, I can tell them, what expenses are deductible. And actually, to your point, you don't need an LLC to have a personal business. That's a legal structure.
Right.
You can be a sole proprietor and under your own social and still be able to take those losses.
Against that income.
Again, against that income, and there's some nuances in the first few years actually where you can be able to offset W-2 wages.
So the ability to buy equipment
Yeah.
and different things, because I know Marty had an idea about creating this cooler and the ability to actually either use it, wrap it around your neck, or different things. So she could buy the equipment for manufacturing that, but also have a benefit on her W-2 side.
Right. Yeah. The benefit of the W-2 is that equipment created a loss on your small business.
Mm-hmm.
And because it's called a hobby loss. After the first 2 or 3 years, it's 2 years really. The third year becomes in question. But the first 2 years, they're like, hey, you're starting a business. And so normally you have losses those years. And so when you have those losses from equipment purchases, you're investing in assets, you're getting coaching, you're getting training. A lot of that can be, offset W-2 income. But again, there's nuances there that we got to make sure are met. But it's very common that we can find a way to get that over to your
We see
1040.
nuances.
So if I don't have a profit, then they're going to come back and say it's a hobby
By
loss.
the third
No,
year.
we're good for the first 2
Okay,
years.
all right.
What I'm trying to say is there's some nuances. Like if you're getting expenses to get a license, so like a CPA.
Yeah.
A CPA is going out on his own. He's going to school to become a CPA, or he's paying for that. When you're paying for that kind of a license, you can't deduct that.
Mhm.
So it has to be more of like advice, mentorship, equipment. Those are the things that we're kind of looking for.
Okay.
But if you're substantially different professionally before and after that expense, that's something that we might not be able to take.
So you say mentorship, is that like hiring a coaching program?
Exactly. We just had an actress actually come on, and she gets mentorship, but it's no licenses. So that mentorship is actually deductible.
Oh, interesting.
On
Yeah.
her W-2 income.
Well, on our business income,
Right.
which will bleed over and offset
Yeah,
W-2 income.
So yeah, I think businesses have the biggest tax advantages that they can,
Oh, yeah.
Yeah.
Absolutely.
but they're also paying for the employee
Right.
and the employer. So
Exactly.
we'll talk about that
Right.
here shortly. But also don't forget some of the other deductions if you're an individual, such as maxing out your 401k, IRA contributions,
Mm-hmm.
if you do have rental properties, et cetera. So there is a way to potentially
Charitable
become a
donations.
business owner, charitable donations,
Yeah.
et cetera. So if you have different questions running through your mind, make sure to send it our way at trajanwealth.com/5QIQ. And for our last question today, a shout out to the business owners and the side hustlers who feel this every year. And I have this question myself is, why do self-employed taxes feel so darn high?
Yeah.
Great question.
Yeah. No, that is a great question. It's almost comical when we find out that our founding fathers, wanted, revolution was over a tea tax, and everything else. And now we look at all the taxes we pay today. So self-employed people actually do get double taxed, and that's very unfortunate. So you get your FICA tax, so the Social Security and Medicare, you pay the employer and then the employee side as well. So it's 15.3% total. So if you made $100,000, you're talking $15,300 just in that tax. That's rough, right?
But does the business side get to deduct that?
Right. You do get an adjustment of half of it on your 1040,
Oh, okay.
but it's not it.
It
It doesn't
still sucks.
soften. Yeah, it still hurts you. It's a deduction rather than a credit.
Right.
So you're paying $15,300. Half of that's almost $7,650. You get a deduction of that amount, but it's nothing compared to what you're paying in, and
Right.
so it hurts.
But at the same time, they need to be paying that because that's going into Social Security and
Right.
Medicare. And that is when we sit down and talk to business owners that want to retire and they have not been paying into,
Right.
then they have, hurt some of the income that they would have in retirement
Right.
because they wanted to just do minimal.
Yep.
Yeah, I mean, I think another thing for the business too, though, is that it's not running through payroll.
Right.
Right.
So when
Right.
it runs through payroll, it's out of sight, out of mind. The business owner, they're subject to the quarterly taxes and they actually have to write that check. So it's very easy to spend that money when it's not already gone.
Right.
That is a big point.
Yep.
But I think that also speaks to why business owners get the biggest tax benefits,
Right.
such as a defined benefit plan.
Yep.
Which we spoke about on another episode. That's the ability to put almost $300,000 away on a pre-tax basis. So as far as business owners, what are some, quick, like a list of items that they could take advantage of? Like we mentioned the Augusta rule.
Right.
So Augusta rule, defined benefit. Can you just go through a handful of some of the more common or uncommon?
Right. Well, a lot of people, use their car for their business, so they track mileage. That's a very common thing that I see people miss, or they don't track thoroughly. So it's just as easy as just, writing it down.
And I learned through you that there's 100% depreciation on a vehicle in year one.
Right. So bonus depreciation, there's some nuances here as well, right?
Yeah.
Weight limit and all that. But yeah, so bonus depreciation is fantastic. So if you bought equipment and everything else, like a lot of people that I talk to that are self-employed are consultants. And they're like, oh, I have no expenses. There's no benefit here. And I'm like, you're on a laptop right now.
Yeah.
Like
And you have
that's
to
a
have
deduction.
Mhm.
You have to have internet. You have a home office. We go over if that's actually applicable and everything. But there's a lot of expenses like that. So like, home office expense, is that applicable to you? What equipment did you really need to buy? Even if you bought it personally a year ago and then you converted it to business use, what was the fair market value? Like we do need to put some, depreciation there.
Mm-hmm.
And then you're right. Like if you buy company vehicles, make sure we do it right. But there's some ways to be able to get some deductions on those.
So if anything, you've learned that businesses have a lot of tax deductions available.
Yep.
And if you're a business owner, tax planning should be just that, planning, not just a once a year meeting with your
Yes.
CPA. So if you find that you're not getting full planning, that's what Trajan Tax, Trajan Wealth, and Trajan Estate are all about. So today we spoke about a few very big tax questions. Should I work with a tax pro? Should I consider Roth conversions? What taxes will hit my kids? What I can do now to avoid future tax surprises, and why self-employed taxes bite so darn hard. So which of those is your story? Share it at trajanwealth.com/5QIQ. Pass this episode to someone who just had a very unpleasant tax surprise. And if they did, also don't hesitate referring them to Trajan Wealth, Trajan Tax, and Trajan Estate. Heck, that's what we do. So plan smarter, dream bigger, one smart tax move today. That's more money working for you instead of leaving your account. So thanks again for joining 5QIQ Financial Power-Ups with Trajan Wealth. I'm your host, Jeff Jr., and we will see you again next week.